There's a billionaire fight in an Oakland federal courtroom right now. The headlines are calling it Elon Musk versus Sam Altman. Tech titans, AI drama, billions at stake. But here's what almost nobody is telling you. If Elon wins this case, the next phone call won't be from Silicon Valley. It'll be from the general counsel's office at every nonprofit hospital in America. And honestly, they will be terrified. Because the question on trial isn't really about AI chatbots. It's whether a charity, a 501c3 that took tax-deductible donations under the explicit promise of serving the public, can quietly convert itself into a for-profit empire where insiders pocket the upside. That is the exact business model of the modern nonprofit hospital. OpenAI's nonprofit foundation is reportedly worth around $130 billion on paper. That makes it bigger than the Gates Foundation and the Ford Foundation combined. Now, guess what the largest nonprofit health system in America brought in last year? $115 billion in 1 year from you. Elon Musk has accused Sam Altman of stealing a charity and posted on X whether America wants to set a legal precedent that it's okay to loot a charity. I want you to hold on to that question in your head, and then I want you to look up your local hospital's tax filing. Let me walk you through what's actually happening in that Oakland courtroom. The case is Musk versus Altman, OpenAI, and Microsoft. Judge Yvonne Gonzalez-Rogers is presiding. There are 9 jurors, but no alternates. Here's what survived to trial after all the pretrial motions. Breach of charitable trust against Altman, Brockman, and OpenAI. Unjust enrichment against the same parties, and aiding and abetting breach of charitable trust against Microsoft. Musk is seeking roughly $134 billion in damages. If awarded, that money wouldn't go to Musk personally, it would flow back to OpenAI's charitable arm. He's not trying to get rich, he's trying to enforce what he says was the original deal. And here's the core of that deal. Back in 2015, OpenAI was founded as a 501c3 public charity. Same legal status as Red Cross, same legal status as your local hospital foundation. The pitch was explicit. AI is going to be the most important technology of the century. We don't want it controlled by a single corporation, so we're going to build it as a charity, publish, research openly, and operate for the benefit of humanity. That pitch is what justified the tax deductions. That pitch is what brought in the money. Musk gave somewhere between $38 and $45 million to OpenAI between 2015 and 2017. All of it is structured as tax-deductible charitable contributions. Then things changed. In 2019, OpenAI created a capped profit subsidiary. Microsoft came in with $1 billion. By 2025, the for-profit arm restructured into a public benefit corporation. The nonprofit foundation kept what it calls a controlling role on paper, but it's now a 26% shareholder sitting alongside Microsoft at 27% and a cap table full of employees and outside investors. And there's a smoking gun document already in evidence. Microsoft's CTO, Kevin Scott, in a 2018 email wrote this: I wonder if the big OpenAI donors are aware of these plans. Ideologically, I can't imagine that they funded an open effort to concentrate ML or machine learning talent so that they could then go build a closed, for-profit thing on its back. Read that again. He's asking whether the donors know what's happening to their charitable contributions. That question applies to a lot more than OpenAI. Here's why this case matters way beyond Silicon Valley. 3 rules of U.S. nonprofit law are on trial. First, the public trust doctrine assets held by a 501c3 are held in public trust and cannot be distributed to private individuals. This has been written into the federal tax code since 1954, and the underlying charitable trust doctrine goes back centuries. Second, the private inurement rule. A charity loses its tax exemption if any of its net earnings flow to insiders. That's IRS code. It's really not ambiguous. And third, the Bob Jones Doctrine from 1983. There, the Supreme Court established that the IRS can revoke a 501c3 status when an organization's conduct violates fundamental public policy. Nonprofit status, in other words, is conditional, it's not permanent. These aren't obscure legal technicalities. These are the exact same rules that govern every nonprofit hospital in America. When a hospital takes a tax exemption, it's making a promise. And that promise is we exist for public benefit, not private enrichment. The question in Oakland is whether that promise still means anything. This isn't the first time we've tested these rules. In the 1990s, there was a wave of nonprofit hospital conversions. Blue Cross of California converted to for-profit status, and the state attorney general forced a very specific outcome. The value of the nonprofit had to be transferred to successor charitable foundations. The California Endowment, the California Healthcare Foundation, both of those still exist today, and both still fund public health work. Here's what the rulebook required back then: advance written notice to the state attorney general, an independent valuation, not just the seller's opinion, but the AG's own fairness assessment, fair market value paid for all the charitable assets, and proceeds flowing to a new public charity, not to insiders, and public hearings in the affected communities, and finally and critically, no direct or indirect enrichment of board members, executives, or advisors. The hospitals that converted in the 1990s followed these rules. The value stayed in the public trust. What Musk is arguing is that OpenAI didn't follow this rule book. They checked some boxes on paper, but insiders ended up holding equity worth billions of dollars. And here's the uncomfortable question: when did nonprofit hospitals last follow this rulebook? To be clear, nonprofit hospitals do real public good: emergency care for everyone, charity care for the uninsured, training, research. Nobody's disputing that. The question is whether the scale of the for-profit empire built inside the charity wrapper is bigger than the public benefit on the other side of the ledger. Let me show you the numbers that almost nobody talks about. The nonprofit hospital sector is enormous. We're talking over $5 trillion a year in U.S. healthcare activity. And the biggest nonprofits are larger than most Fortune 500 companies. Kaiser Permanente, $115 billion in revenue last year. It's a nonprofit. Common Spirit Health, $38 billion, nonprofit, Catholic. Advocate Health, another $34 billion, nonprofit. Providence, $30.7 billion, nonprofit and Catholic. Ascension, $27 billion, nonprofit, Catholic. Now, here's the tax exemption side of the equation. The American Hospital Association's own commissioned analysis pegs federal tax exemption at about $13.2 billion in a single year. Their defense is that hospitals return 10 times that in community benefit. But here's what the independent research actually shows. The Loan Institute analyzed over 2,000 nonprofit hospitals using the same IRS data. They're finding 80% of nonprofit hospitals, that's 1,940 out of 2,400 or so, spent less on charity care and community investment than the value of their tax exemption. Combined deficit, $25.7 billion. Let me give you some specific examples. Cleveland Clinic main campus, net income over $1.1 billion. Community investment as a percentage of expenses, about 2.64%. Stanford Hospital, net income over $1.3 billion. Community investment, about 2.5%. Hospital of the University of Pennsylvania, community investment as a percentage of expenses, 0.25%, a quarter of 1%. Now, here's the peer-reviewed smoking gun. A study published in Health Affairs looked at 2,219 nonprofit hospitals from 2012 to 2019. And here's what they found. Operating profit at the average nonprofit hospital went from $43 million to $58.6 million. Cash reserves went from $133 million to $224 million. And charity care spending? It went from $6.65 million to $6.36 million. It went down. Every dollar of new profit was associated with $1.73 of new cash reserves and zero statistically significant increases in charity care. The author's conclusion, and I'm quoting, nonprofit allocation of profits to cash reserves over charity care questions the tax exemption justification. But it gets worse. These hospitals didn't just sit on their money, they built for-profit empires inside the charity wrapper. Hospital employment of physicians rose from 27.5% to over 47% between 2008 and 2016, the steepest vertical integration wave in U.S. medicine. And that was in 2016. By 2024, more than 3 out of every 4 U.S. physicians work for a hospital, health system, or a corporate employer. What happened to prices after hospitals bought up physician practices? Physician prices rose 15% within 2 years. Hospital prices rose too, and here's the kicker, no measurable improvement in quality. Almost all of these acquisitions slipped below the Hart-Scott-Rodino antitrust reporting threshold. The FTC literally never saw most of them. And then there's the 340B drug program. This program was created in 1992 to help safety net hospitals serve low income patients. Hospitals buy drugs at 25 to 50% below wholesale price. Here's how it actually works today. A hospital buys a drug for $1,000 through 340B. They bill your insurance company $3,000. The hospital keeps the $2,000 spread. Total 340B purchases in 2023 were over $66 billion. According to the USC Schaefer Center, it's now the second largest drug purchasing program in America after Medicare Part D. A Senate Health Committee report found Cleveland Clinic generated about $933 million in 340B revenue between April 2020 and June 2023. The same year, that program brought in hundreds of millions. The hospital booked $911 million in net income and spent $37 million paying 22 executives more than $1 million each. One hospital system in Indiana added $1.3 billion in assets in a single year. $740 million of it was investment income. Meanwhile, a Methodist hospital in Memphis sued over 8,300 patients between 2014 and 2018, including dozens of their own employees, with wage garnishments granted against more than 70 of them. They own their own collection agency, and the CEO took home $1.6 million. Ascension, the Catholic health system, operates a private equity fund with over $1 billion in assets. Two of their executives moved into running it and out-earned the CEO. St. Jude's Children's Research Hospital holds $5.2 billion in reserves, enough to operate for 4.5 years with zero new donations. Meanwhile, dozens of St. Jude families maintain GoFundMe pages to cover housing and travel. This is what nonprofit healthcare looks like in 2026. Let me put OpenAI and your local hospital next to each other. Original 501c3 charter, OpenAI promised to benefit humanity with open research and no corporate concentration. Hospitals promised to care for the poor and advance public health. Tax-deductible donations received. OpenAI took tens of millions. Hospitals take $13.2 billion per year in federal tax exemption alone, plus state, local, and property tax breaks. Did they build for-profit subsidiaries? OpenAI created a capped profit company, then a public benefit corporation. Hospitals created hundreds of taxable subsidiaries, physician groups, ambulatory surgery centers, real estate holdings, captive insurers, and venture funds. Did the nonprofit retain control? OpenAI says the foundation still controls the for-profit through a 26% stake. Hospitals say the parent nonprofit controls the taxable subs, but the value increasingly sits in those subs. Did insiders benefit financially? OpenAI has stated on the record that Sam Altman holds no direct equity in the for-profit. Musk filings anticipate otherwise. The cap table is private, so neither side has produced public documentation. At hospitals, executive compensation is documented. We know the Methodist CEO made $1.6 million while suing patients. We know Ascension's investment executives out-earned their own CEO. What about mission drift? OpenAI moved from open research to closed source commercial products. Nonprofit hospitals saw charity care decline while profits and reserves grew sharply. What about regulatory visibility? OpenAI notified the IRS, the California AG, and the Delaware AG. No enforcement action. Hospitals quietly acquired thousands of physician practices below antitrust thresholds, and regulators never saw them. Procedural integrity? OpenAI got a fairness opinion, board approval, and regulator disclosure. Hospitals didn't even bother with fairness opinions for most of their acquisitions. So strip the AI sticker off the story and put a hospital sticker on it instead. Same fact pattern, same legal question. Let's talk about what this verdict could actually mean for healthcare cost. There are 3 scenarios to be fair. Scenario 1, Musk wins outright. The conversion gets unwound or significantly constrained. The doctrine that insiders cannot pocket equity from a charity's accumulated value gets locked back in. Every nonprofit hospital system that was quietly contemplating a spinoff, a joint venture with a private equity, or a for-profit conversion, they're frozen. State attorneys general in California, New York, and Massachusetts get political cover to audit existing for-profit subsidiaries. The plaintiff's bar starts filing breach of charitable trust suits against hospital systems, particularly around physician roll-ups and surgery center ownership. The IRS opens a review of dual-status hospitals under the Bob Jones Doctrine. Scenario 2, mixed verdict, and this is what most people think is the most likely outcome. The court issues procedural rules. Future conversions would require explicit donor notification, mandatory AG reviews with findings, fair market value paid by insiders for any equity, and increased disclosure. Within 12 to 24 months, the IRS and state AGs add these requirements to hospital roll-ups, joint ventures, and venture arms. Hospital systems quietly restructure their for-profit subsidiaries to look more like the 1990s Blue Cross model, and value flows to the charity, not to the insiders. 340B reform accelerates because the legal logic is identical, a charitable subsidy generating private spread. Scenario 3, OpenAI wins outright. The door swings open. Expect a wave of nonprofit hospital conversions over the next decade. Donors react by demanding no conversion clauses at the moment of giving. The IRS issues new regulations within 2 to 3 years to set procedural floors. The most likely losers are small community hospitals with no scale to convert profitably and patients in already concentrated markets. Now, here's the healthcare cost angle. The peer-reviewed evidence already shows that nonprofit hospital consolidation drives prices up without quality gains. 47% of U.S. metro areas are controlled by 1 or 2 health systems. 97% are highly concentrated under antitrust guidelines. United Health's own analysis says hospital consolidation is the dominant single driver of medical cost inflation. A Musk-style ruling applied to hospitals could force divestiture for-profit physician roll-ups, restored competition, spin-off of ambulatory surgery centers as standalone competitive entities, and transfer of accumulated cash reserves into independent successor foundations that actually fund care. Tighter 340B eligibility, refunding spread to patients, renewed antitrust scrutiny of below-threshold deals. The CBO and academic literature both suggest these changes, breakup of integrated systems, restoration of competition, would lower commercial healthcare prices. That's the single fastest growing line item on your insurance premium. So the trial in Oakland isn't really a billionaire fight. It's a stress test of whether U.S. charity law still has any teeth in 2026. The question isn't complicated at all. Can a charity that took tax-deductible money under the promise of public benefit convert itself into a for-profit empire where the insiders pocket the gains? That's what Elon Musk says happened at OpenAI. But the institution that should be paying the closest attention to this verdict isn't Anthropic, it isn't Google, it isn't Meta. It's the hospital 15 minutes from your house. Because by every operational measure, insider enrichment, mission drift, commercial scale, weak regulatory oversight, the nonprofit hospital sector is harder to defend than what OpenAI did. They didn't even bother with a fairness opinion. They just kept the charity wrapper and built the for-profit empire inside of it. The advisory jury verdict could land within weeks. The judge's binding ruling on the remedy will follow. And whatever happens to OpenAI, the legal doctrine being tested applies to every charity in America, including the one that sent you a bill last month. I hope you enjoyed this content. If you do, please like and subscribe to the podcast.